If you've been trying to build a strategy around MACD and failing, that is not your problem because really MACD doesn't generate good signals. Now, there are many variations on MACD and I've done a couple on this channel. And today's video is about a new variation on MACD that use volume. Most likely you already know the on-balance volume indicator. Basically, it's an indicator that measures the accumulation of volume and the distribution of volume. So whenever there is buying volume, it's added. And whenever there is selling volume, it's deducted. So basically, it measures the pressure of buying and selling on any instrument. Now, MACD, it's the difference between two moving averages on the close of the instrument. So basically, it's a price momentum indicator. And combining these two, you will have two data inputs. Basically, you have volume and price in a single indicator. And we will see if this makes a difference or not. I saw the indicator on TradingView, but the version on TradingView is very complicated. Basically, there are too many options. And as algo traders, we need less options because you want to get rid of overfitting before even start to optimize. So what I did is strip down the version on TradingView to 4 inputs. Basically, the TradingView version had 14 ways to calculate the moving average. I picked the double exponential moving average. And there were more options to select the smoothing average for unbalanced volume and the length of the standard deviation. And I think another input that I forgot. But basically, I stripped down the indicator to only 4 inputs. Now, that's still a lot, but it's much better than 7 inputs. So here is the indicator on the chart. So I have here the S&P 500 index, and this is the regular MACD. So this is the MACD, and this is the signal, which is the average of MACD. And the histogram is the difference between the MACD line and the signal line. And below it here, we have the on-balance volume MACD. And from just the first look, it looks extremely similar. But if you dig down, you will see that even though they have the same curve, this one, the unbalanced volume MACD, looks to react a lot faster than the normal MACD. Now you see the green and red line here. Basically, when we are above the signal, it's green. Below the signal is red. Same thing is here. I just didn't plot the other options. And we can switch this here also. So let me switch these to false. So now this is the MACD and this is the unbalanced MACD. And it's easy now to compare them. And as you can see, look at this. So it switched to green before this one and it switches to red before this one. Again here, it switches to green before and it switches to red before. And this one switches to green at the same time, but switches to red like just 1 bar before that. Here switches to green before and switches to red 1 bar ahead. And I checked a lot of data points on the indicator, and usually the behavior is it reacts quickly to the up and down movement. So even though it's the same curve, same values, but the reaction is a lot quicker. But of course, we need to test to see if that adds any value to a signal for our strategy. So the best way to see if the indicator is better or worse is through strategy optimization. So I applied here the strategy. Basically, when we switch to green, we buy, and when we switch to red, we sell. So we don't care about the value, if it's above 0 or below 0. We only care about the switching from green to red. So we always buy when it switches to green. We sell when it switches to red. So here are the inputs for our strategy. So the first line is between the MACD and the unbalanced MACD. So 1 is unbalanced volume MACD and 2 is the regular MACD. The volume standard deviation length and the volume smoothing are only related to unbalanced volume. So we will fix these, we will not alter it. And then we will optimize only this to see the difference between the MACD and the unbalanced volume MACD. So I will optimize the fast length from 6 to 24, step 2. The slow length from 14 to 50, step 4. So all in all, we have 200 optimizations. And if we sort our optimization by return to drawdown ratio, that should give us the best strategies on the top. And let's look at the top 20. So we have 13 strategies that are using the MACD and 7 strategies that are using the unbalanced volume MACD. So it doesn't look like the volume is adding any value to MACD. And this is really an important lesson to keep with you as an algo trader. So regardless of how fancy the indicator is, at the end of the day, you want a better quality signal or a better quality filter. That's the only reason you have an indicator. It's either to generate signals for entry exit or to generate filters to allow the signals to come in and out. And only through testing that you can tell if the indicator is doing better job than another indicator. In this case, we are comparing it to the original MACD. And from the first look, it doesn't look like it's giving us any added value. Now, since we have the additional volume, we can also optimize the volume for the unbalanced volume MACD. So let's do that. So now we will fix the unbalanced volume. We don't need to optimize that. And now we will add the volume optimization. So let's leave the fast length and slow length same optimization. And now let's optimize the volume standard deviation length. So let's go from 10 to 40 probably in step of 4. And we'll do the smoothing from 5 to 25 in step of 5. That gives us 3,500 combinations. And if we sort by return to drawdown ratio, now we have better strategies showing up. It is better, but it's not significantly better. Now, this might still be good because even though the performance is not a lot better, but we might get a totally different equity curve, which helps us a lot when we are building a portfolio. So the less correlated the strategies you add to a portfolio, the much better the performance of the portfolio. Now, the top performing strategy is making $158,000. But we have strategies that making more, but we are always, I am always interested in better return to drawdown ratio because, I want to reduce the drawdown as much as possible and I can always enhance this amount of money with a filter. So let's try that. So let's pick this one, which is 22 and 46, 30 and 10. And you can see number 2 is also really close and it's making more money. But let's stick to this one. Here is the optimization for direction and volatility filter. So let's sort by return to drawdown. Now you can see we can go to 7.6, 7.6. So you can see we have more than 70 strategies that are doing much better now because of these filters. Also now I can pick something like this, which makes a lot more money and also a higher return to drawdown ratio. So this filter is volatility and direction combined, and this one is making $178,000. This is only a directional filter. So even though it's very simple, but the enhancement to the strategy is significant, making a lot more money, less drawdown, which gives us higher return to drawdown. So if I pick this filter, let's see how the equity curve looks like. And this is a very nice equity curve. If you want to combine this in a portfolio, it looks really nice. There are no huge drawdowns and it's always making a higher highs. We look at the trade analysis. This one, 196 trades, 63% win rate. Really, really good average trade for the S&P 500. And finally, periodical analysis since 2006. We have 2008, a little bit of a loss. 2018, big loss. 2022 is a big loss. So this is really important because most mean reversion strategies did really well last 4 years. So you can tell that immediately that this will not be highly correlated with those strategies. 2023 and 2024, it did amazingly well. Now this is trading a single contract. So most likely this is like a 200% return and this is like a 150% return. Really, it doesn't matter what indicator you use. Your target is to build a strategy with low drawdown basically higher return to drawdown ratio, and not correlated with the other strategies. Of course, you don't know, you need to build a lot of strategies and then pick the least correlated strategies and put them in a portfolio to trade. So even though it's the same instrument, the same mean reversion style, same direction, which is long in this case, you can still diversify by having different indicators, different signals, and you will get a smooth equity curve of the portfolio. To learn more about MACD, watch this video and I will see you there.